Let's discuss the outlook for gold going into the end of 2023. Talk about the several cross currents influencing the prices, both the headwinds and the tailwinds right now. And naturally, take a look at the charts to get an idea of what may be the key levels to watch. There are several cross currents driving the gold price at the moment. But overall, it does seem to be that gold is a function of geopolitical risk. In particular, we have seen the price surge since Hamas's attack on Israel, and these real fears that Israel's retaliation, a ground incursion into the Gaza Strip in an effort to, rid the territory of Hamas influence once and for all, could spiral into some sort of regional conflict, which could both have economic consequences as well as financial consequences. In particular, if it does draw in other combatants in the region, those perhaps that might look to throw military or even some sort of material support behind Hamas. We're looking at Iran in particular, that could attract further sanctions and obviously push some actors into gold as a possible store of value. So the real run-up that we have seen in prices recently is because of geopolitical risk and has come despite the fact that the typical fundamentals for gold have been very unfavorable. And that's when we start to talk about the macro backdrop. We're talking about the run-up in yields, which has seen US Treasuries basically touch 5%. That's the yield, of course, almost across the entire yield curve. Now, there's a number of factors driving this. It's a part of a US economic resilience story. Growth has been stronger than expected, but there's also the element of higher bond issuance from the US Treasury, putting downward pressure on bond prices. Yields obviously work inverse to prices, along with the fact that the US Federal Reserve is on a quantitative tightening campaign in a bid to try and tighten financial conditions, increasing bond supply, again, lowering bond prices, pushing upward pressure on yields. And typically that's a bad formula for gold, especially when you consider that it's not just nominal yields that are rising, but it's also real yields. So the nominal yield minus inflation expectations reaching levels around 2.4 to 2.5%, which is fairly consistent with, a lower gold price levels, in fact, in real yields that we haven't seen for around 23, 24 years, arguably since the dot-com boom. So gold has diverged from that fundamental influence, along with a stronger US dollar. It's actually trading in a fairly positive correlation with the US dollar, which is not unusual when you consider that sometimes happens in moments of risk off in the markets, like we're seeing now because of this geopolitical risk. But still, it sets up this dynamic where gold is really performing as a function of these geopolitical risk of what's happening in Israel and the Gaza Strip right now, and not because of these fundamentals, setting up this kind of dynamic that if, the geopolitical risks disappear, gold prices could snap back quite considerably just because those other fundamental drivers, which it typically is driven by, again, they're going in the opposite direction. So let's take a look at some of the technical indicators now and the key levels to watch for the gold price. And as we can see over the last week or so, we have seen something of a pullback after that breakout from that downward short-term downward trend channel, which prices broke out of when we did get the catalyst of the war in the Middle East, pushing that kind of safe haven play into gold. Interestingly enough, we haven't seen prices able to remain above $2,000, which is a key psychological level and does act as a area of technical resistance for any kind of period of time. So it sort of indicates perhaps that, maybe some momentum is slowing there to the downside. You can see that somewhat on the RSI. And there's the question that if we don't see any further conflagration in the conflict in the Middle East, that maybe some of the risks there of an escalation and a broader regional conflict will see prices come back to the fundamentals of real yields and the US dollar. That was the weekly charts, a slightly longer term view. And of course, we could see some of the key resistance levels above 2,000 and towards that sort of 2,070 mark, which was an all-time high. The bottom of the range was around $1,600. Gold price ultimately in the long run, fairly range bound, but in the short term, here you go. Here's the daily charts. And we're starting to see significant signs of, weakening momentum and a potential pullback coming through. The RSI was in oversold territories, has pulled back and reversed lower, suggestive of a market losing momentum. Price is having trouble pushing above the 10-day moving average, which was acting as a level of support recently. Now sellers emerging above that level to push the price lower. If we see something of a breakdown below 1974, there is a confluence of levels around 1950 that might be key for traders. On the flip side, if we get a push above that 2000 level, really the highs was around 2010, 2015 or thereabouts. That might mark a little bit of a continuation. But one would imagine, again, given the drivers of the upside recently, it will take something of an inflammation of tensions in the Middle East to push that higher. Otherwise, well, if things start to improve on that front, maybe going into the end of the year, the positive real yield story, as well as some of those, other factors that typically drive gold, well, we could see price sort of reverting to those rather than being a reflection of geopolitical risk. So there's your look at the gold market at the moment as we head into the rest of the year. It will be very much determined by what happens in the Middle East and how that conflict evolves. If things deteriorate further, well, that provides further potential upside risk for the gold price. If it doesn't, well, we go back to talking about the monetary policy story, what the Federal Reserve is going to do with rates, what behavior we're seeing in bond yields, and to an extent as well, the strength or weakness in the US dollar, which is a factor of safe haven flows, as well as the extraordinary outperformance we are seeing in the US economy.